If you look back through history, every technological revolution has followed a pattern. Initial breakthroughs spark a frenzy, exponential advancement further propels excitement, and soon enough, speculation and hype create a bubble that eventually bursts. And what is left is only the strongest survivors who reshape the future. The railroad, the automobiles, the internet each went through the same cycle and through the destruction created new giants and new opportunities. Today, AI is standing at the very same crossroads. But there is one important difference. The scale and the speed are unprecedented. It's the first technology capable of truly automating cognition instead of just mechanizing tasks. Its impact won't just be digital. It will transform every job, every industry, and every investment portfolio in ways that we're only just beginning to grasp. More than 1 trillion US dollars has already been invested in AI infrastructure globally, ranging from hyperscale data centers and purpose built chips to fiber networks and high voltage electricity grids. The global AI infrastructure market is projected to reach about 164 billion US dollars by the end of this year and is well on track to reach about 850 billion US dollars by 2034. In the US, the epicenter of this surge, the market is projected to reach from about $50 billion today to $150 billion in the next 10 years. This growth is fueled by big tech's massive bets. Microsoft is deploying about $80 billion, Meta about $65 billion, Amazon and Google tens of billions more, and private players are investing at an even more staggering rate. This explosion isn't just limited to North America. Europe's investment in sovereign cloud AI data centers is expected to hit about $41 billion by the end of this year and is expected to grow at about 20% annually. Even India is expected to add about $400 billion to its economy by 2030 through AI infrastructure and other initiatives. Before we move any further, if you're new here, I am Avni. Welcome to The Next Big Thing, the channel where I aim to find future's most explosive investment themes before they go mainstream. From lab-grown diamonds to semaglutide, from AI to SMRs, my goal is to help you spot long-term multi-bagger opportunities. So if that's the kind of edge you're looking for, you're exactly in the right place. Now, why all of this matters is pretty simple. The backbone of AI, the infrastructure itself, is where the most durable opportunities for investors will be found. But the question is, how do you make money from this global infrastructure arms race before the next inevitable bubble bursts? And even before that, is AI really a bubble? On one hand, according to Goldman Sachs, the current enthusiasm for technology stocks and AI is fundamentally different from past bubbles. They say companies like Alphabet, Apple, Amazon, Broadcom, Meta, Microsoft, Nvidia, the Magnificent Seven, now deliver robust profits to justify their valuations. According to the report, these companies anchor the market and provide a solid foundation that keeps things from overheating dangerously. But not everyone sees it this way. Sam Altman, for example, warned that we're living through an era of overexcitement. Drawing a clear parallel to the dot-com bubble, he said, when bubbles happen, smart people get overexcited about a kernel of truth. He also said someone is going to lose a phenomenal amount of money. We don't know who, and a lot of people are going to make a phenomenal amount of money. So who's right? Goldman Sachs focuses on the big tech players' profits, but they're missing a very important piece of the puzzle, which is all of these new AI startups popping up. And this is important because a lot of these companies are getting a ton of cash without actually showing how they'll make money or how they'll become sustainable. Honestly, a lot of hype around AI these days seems more a speculation than actual solid progress. A research from MIT strongly supports this caution. In the study of about 150 business leaders and about 350 employees, MIT found that about 95% of generative AI projects fail to deliver any measurable returns. Despite about 30 to 40 billion dollars invested in enterprise AI and about 250 billion dollars invested in broader corporate AI, most firms deliver little to no payoffs. It is a modern replay of late 1990s web boom. Venture capital tells a similar story. Y Combinator's latest 2025 spring cohort includes about 70 agentic AI startups, part of a surge in AI-focused funding rounds at eye-watering valuations. In 2025, about 64% of the US VC went into AI, with examples like Safe Superintelligence raising $2 billion with no product, and Magic AI pulling in $500 million across 2 rounds despite zero revenue. Meanwhile, even for the companies that actually have products and revenues, valuations for them far outpace said revenues. OpenAI, which is valued at about $300 billion, is projecting about $5 billion of losses in 2025. Yes, you heard that right. And it's not just OpenAI, many pure play AI companies have the same story. Soaring valuations, rapid spending, and as yet little revenue to justify the hype. Now, I'm sure all of this sounds familiar, right? Back in the day when the dot-com bubble burst, Nasdaq, which had soared from under 1,000 points to over 5,000 points, crashed about 70%, wiping out about $5 trillion worth of investor wealth. But as we all know, internet wasn't just hype, it was genuinely revolutionary. So then why the bubble and why did it eventually burst? The problem wasn't with the technology, it was with the valuations and the mindless funding of anything with .com in its name. Yet, from this destruction, this wreckage, emerged some of today's most valuable companies. Companies like Amazon, eBay, Yahoo survived this crash because they had real revenue streams, they had a clear business model, and they had strong leadership, unlike their competitors. And Google, even though it got listed after the crash, it thrived because it built on the infrastructure that the bubble had funded. So, the very first lesson for us as investors to identify survivors is to follow revenues and not promises. The dot-com crash also gave us another important insight, which is infrastructure providers survive technological transitions better than application companies. During the dot-com boom, companies providing networking, hosting, or data center services weathered the storm much better than pure play internet companies. Just like during the California gold rush, shovel sellers made more consistent profits than actual gold miners. Some of the examples of these kind of companies being Cisco, Intel, Sun Microsystems. These companies made it through the dot-com crash because they provided essential products or services and they had a wide variety of customers. Cisco's networking gear was a must-have for established companies. Intel's processors were needed both by companies and everyday users. And Sun's servers kept the internet running smoothly. The pattern is clear. Companies with a diversified customer base, recurring revenue streams, and real value propositions survive, while those dependent on speculation and unsustainable business models disappeared. Coming back to AI though, this revolution requires unprecedented infrastructure spending. Big tech is on track to deploy about $320 billion by 2025 on AI infrastructure, up from just $230 billion last year. This scale of investment creates a few clear buckets of opportunity. The first is power and cooling. AI data centers use about 5 to 10 times more power per rack than traditional facilities. This is pushing operators to experiment with new solutions. One of the most interesting developments here is the use of small modular reactors or SMRs. Essentially, these are next generation nuclear power plants that can sit next to data centers and provide 24/7 clean power. Google has already started moving in this direction and I expect others to follow. I'll dive into SMRs in a future video. It's a next big thing all on its own. So make sure to subscribe and stay tuned so you don't miss it. The second bucket is physical real estate, meaning purpose-built data centers optimized for AI workloads. An interesting example here is Nebius Group. They're listed as NBIS on Nasdaq. They are one of the few pure play companies that you can actually invest in today. They build and operate cutting edge AI data centers across 6 countries with advanced cooling, behind the meter power, and racks that can handle about 500 kilowatts. They're not just landlords though, they design their own proprietary servers and racks. These are tightly integrated with Nvidia's latest GPUs. Incidentally, Nvidia is both a partner and investor in Nebius Group, and through this agreement, Nebius enjoys priority access to the latest and most powerful GPUs by Nvidia. Their numbers are also wild. In Q2 2025, they reported 105 million in revenue, up 625% year on year and 106% quarter on quarter. They've already achieved positive adjusted EBITDA and landed a $19.4 billion contract with Microsoft to deliver AI capacity in New Jersey. And off the back of this deal, they have raised their annualized revenue guidance for 2025 from $900 million to about $1.1 billion. On top of that, they're scaling to secure about a gigawatt of power by 2026, which for context is enough to run a small city. At around 80 times sales, their stock definitely looks expensive, but when you're growing about 600% a year, traditional metrics do not really capture your story. For more defensive AI investments, data center REITs like Equinix or Digital Realty Trust are strong options. They own critical AI infrastructure, offering stable 2 to 3% dividend yields. In 2024, data center REITs returned about 25% with 2.5 to 3% dividend yields, vastly outperforming traditional REITs. For context, office REITs achieved about 19.7% and hotel REITs achieved about 18.8%. Then the third bucket is specialized hardware. Now, this is the category most people think of first: GPUs, TPUs, and custom silicon. Nvidia is the obvious winner here, already pulling in about $60 billion a year for AI chip sales. But it's not just them. TSMC manufactures almost all of the world's most advanced AI chips and controls about 67% of the foundry market, which means they'll definitely make profits no matter which AI companies rise or fall. Nebius, as I mentioned earlier, also overlaps in this category because of their custom server and rack designs. And the final bucket is network infrastructure. This category often gets overlooked but is becoming as critical as chips themselves. Linking thousands of GPUs together requires ultra high bandwidth and ultra low latency networks. Arista Networks is one such company that has positioned itself into the middle of this space. They're selling specialized switches and interconnect equipment that makes massive AI workloads possible. They're essentially productizing the connective tissue of AI stacks. And as workloads scale, their importance will only grow. Now, apart from investing in pure play AI infrastructure companies, established tech giants like Microsoft, Apple, Amazon, Google, Meta, Oracle, etc. offer strong AI exposure with built-in downside protection. They're integrating AI to enhance profitable businesses instead of solely relying on AI. And they possess robust balance sheets, strong customer base, and a diverse revenue stream. This allows them to withstand market downturns better than pure play AI companies. Cases in point being Microsoft's Copilot or investment in OpenAI, Google's AI enhancing searches, or Meta's investment in AI for engagement, or Oracle's AI infrastructure, etc. Okay, now that we've talked about where to put in money to gain from this AI revolution, there is another aspect that we need to focus on. It is really important to see how much AI is changing things. While it is creating new investment opportunities, it is also making some of the older ones less appealing. That is why you absolutely need to AI-proof your investment portfolio. Take a closer look at your portfolio and seriously think about divesting from companies that have been significantly affected by artificial intelligence. We are witnessing both the greatest technological revolution of our time and the most dangerous speculative bubble in financial history. And mind you, these two realities are not contradictory, they are historically consistent. The dot-com crash taught us that revolutionary technologies create both enormous opportunities and devastating risks. And only the companies with the strongest fundamentals, diversified revenue streams, and a clear path towards profitability survive the market corrections. So those are the exact kind of companies that we as investors should focus on, and completely avoid companies that are existing only on AI speculation. But this does not mean avoiding all pure play AI companies. Nebius Group is a perfect example of one of those companies which might survive despite the risks. But it does mean being extremely selective and focusing on the actual value being created rather than compelling PowerPoint presentations. The AI revolution, as we all know, is real, but so is the bubble in my opinion. And mind you, I'm not an expert, but I've done my fair share of research. I'll leave you with this today. The key to successful investing is understanding both the revolution and the bubble and making smart choices. Bye for now. If you appreciated the video, please press the like button and subscribe to stay tuned for more.